9 hardware founders and 1 investor who's backed dozens of them. One subject they all know from the inside: what it actually takes to raise capital when you're building something physical. This is the Why Design investment and fundraising compilation.
We're trying to close a round at the moment, a funding round, and we've been struggling. It's been really tough out there. The investment market is quite difficult, and we had a call with, I would say, a great investor. We are very keen to work with them. They understand our segment. They're in ag tech. They've worked with other ag tech robotics companies. So they understand the market, and they basically said, look, we love your company, we love the team, we love your traction, we love where you're taking the product, but your company valuation is way too high. It doesn't stack up against your revenues. They gave us the information that we kind of felt like our valuation might be too high, but they were open and honest with us, which is something we don't often get with investors. We took it on the chin. We pivoted and we went back to our lead investor, changed our valuation, and actually it stimulated interest from the previous investors who maybe turned us down because our valuation was wrong. So I'd see it as a real positive, real learning.
Hardware funding is a different game. Most fundraising advice was written for software. Hardware founders spend years figuring out what is different. The guests on this show put it plainly.
You need money to build regulated medical hardware. So can we raise money for it? So the first sort of 12, 18 months of Béa, sort of 2020 into early 21, was a lot of grappling with like feasibility, building decks, trying to pitch, trying to figure it out, and eating a lot of beans because, of course, you're not taking a check at that point because there's no monies. Of course, it's probably going to come as no surprise that to close my very first round of funding, I ended up speaking to something like 283 investors, and I think I closed 15 of them. And, of course, like I was pretty naive at the time. I'm sort of a little bit more battle hardened now, I suppose. But you sort of raised 500K. And with this 500K, I thought, my goodness, we're going to build the product and get through regs and get it to market and start generating some. It's all going to happen. Of course, that 500K lasted like 5 seconds. We had to go back out and raise again. But I think certainly the pushback in the early days was, who the hell are you to think that you're going to create this?
Hardware is hard. I fundamentally believe that if we stop developing hardware, we're goosed. So I think we have to have people doing hard stuff for hard problems in hardware. But funding is difficult in medical devices, full stop. So I would not like to say, just because you're doing a vascular device, it's easier. I think it's just a more known pathway. It's the structure of your roadmap is clearer, and your go-to-market strategy is clearer. And then the also piece that is important is that you've got clear line of sight on strategics and acquirers, and kind of how they're playing out in the market. So that's the difference. Doesn't mean that there is no funding, no, but it does take a bit more work and a bit more creativity.
What investors actually need to see. The billion-dollar question is not whether you're solving a real problem. It is whether your business maps to what investors are actually measuring. 4 guests on what they learned when they understood that.
Yeah, and it's remarkable how that doesn't move the needle at all. Actually, I really thought a wall of baby photos and a deck, people would go, my goodness, this is investable. Like, this is changing lives. This is actually doing something. And they're all like, yeah, but what are your unit economics? Like, what's the scale potential? Is this going to really be $1 billion business? And look, I get it from an investment perspective. They're looking for $1 billion exit. Babies are no.
You've got to get market penetration. You've got to get volume. You've got to get that factory relationship in a good place. And you're only going to get that as and when you've got some volume going through there. And it's easy to go back to investors and go, look, we've sold a lot. We haven't made much margin on that. And we've got mechanisms for improving that margin over time. than it is to go to investors and go, look, we haven't hit our numbers, we haven't sold much volume at all, but we've made loads of money on each product. And they're like, well, yeah, and we weren't in it for a quick return, Phil. What we wanted to see is volume. And if you can prove the volume, then arguably they put more money in if necessary to kind of then find those kind of ways of improving the margin. Of course, when you've got volume as well, and you can then negotiate with your manufacturers, and you can squeeze the margin there anyway. So yeah, I think that was a big lesson, really.
Now we understand the problems and the constraints of the current platform. We're going to develop the next generation. And actually, one of the big things that I've learned, and it's quite exciting to me, and I've had to pivot the roadmap, is that our current robot will hit our return on investment. So it's, for me, I'm going to do a lot of strategy around when do I start working on the next generation. We call it the version 4. Do we need to develop it, or can I delay it and generate the revenue? That's the big challenge for us, but it's an exciting challenge.
I have actually sat in an investor meeting where the persuasion was 99% done, and the entrepreneur made this bold claim, and their head of engineering said, "No, we can't do that. We don't have enough data to prove that that's possible." And the investment just went poof. Most overrated piece of advice: put the team slide as the 17th slide in the deck. Investors invest in teams. Team slide needs to be like 3 slides in. How do I know who I'm investing in?
Sort the structure before you raise. The things that kill hardware fundraising rounds are usually set in motion long before the pitch. Cap table, founder vesting, who you build the team with, and how you talk about the problem all need to be right before you walk into the room.
I'll give you a classic example where one of my portfolio companies is deeply into alternative material manufacturing. The science had everything you would want, right? It's pure circular economy, huge potential market, interested customers, some of the top brands that you can imagine. And it was 3 co-founders. And unfortunately, they didn't have a founder vesting agreement. We insisted that they do a founder investing agreement. They resisted. We foolishly let them into the program anyway. About a year in after the program, they'd raised their first money, and they had an argument between the 3 founders, and they ejected one of the founders. And because they didn't have founder vesting, that founder took a fairly large chunk of the capital of the company, like a fairly large chunk of the equity with them, and just sat on it, pissed off. So all future raises were tainted by that dead weight on the cap table. The 2 remaining founders buckled down. They did manage to raise some more money, worked very hard, and then somewhere around after the 3rd capital raise, they had a big fight. And one of them left on very reasonable terms. The other one, as far as I'm concerned, is just not a good person. They've always had this ambition. There's this idea that people rise to the level of their own incompetence. Well, guess what? And now they're dead. And that exact story is actually played out more than once. So first things first, don't have too many founders. Right? 3 is about the limit. 5 is pushing it beyond. I had a company with 15 founders. It didn't even make it to the first capital raise. Second thing, always have a founder vesting agreement, basically a prenup for entrepreneurs, because the company needs that equity back if you leave early. And, you should leave, there's good leaver, bad leaver provisions. If you're a bad leaver, you should just be dropped like a hot potato. If you're a good leaver, then you should get something ongoingly and not the big chunk that a founder deserves, because that equity needs to be working hard for the company to actually succeed. And so while it may feel a little grinchy to give up a big chunk just because you left, especially if you've invested a lot of time and effort before you left, it needs to be painful like that so that you actually have a really good thought about, well, should I reconcile with my founders or not? It does more than just keep the company alive when someone leaves. It also is a very strong motive for people not to blow up against each other, because there's something real at stake.
Gosh, I mean, what didn't they push back on? I'll be honest. In the early days, one of the things I got most was, hang on a second. You're not a clinician. You're not infertile. You've never built hardware before. Like, why on earth are you the person to make this happen? Also, you're a female founder and 2% of VC dollars go to female founded companies. So like, you're fighting for a smaller pool of capital to begin with, right? And then in that pool of capital, everyone's like, wait, hang on. And they're trying to do the math on the percentage chance that this is ever going to become anything at all. I had a co-founder, a male co-founder. And I remember I was in a call with an investor once, and it kind of didn't hit home that there was any kind of like structural issue at all until this call, when he was being asked what his vision for the company was. And I was being asked how I would manage family and flight schedules between here and the US when it came time to launch in the US market. I was like, wow, shouldn't I get, like, I'm driving this whole thing. Like, I'm the one, right? Like, shouldn't I get asked what my vision is for the company? So I came out of that call and I really sat with that. And I thought, my goodness, well, that doesn't seem right. So there was a lot of pushback in the early days, and sheer force of will. Even to this day, I think it's sheer force of will. We're still coasting on sheer force of will that, we exist as a company, because raising capital hasn't been easy. But, why you? Why this technology? Oh, well, this company in the market failed. Why won't you fail? You're going to fail like them. What's different? Like, there's all of this pushback happens all of the time. And I think the core theme of everything that has come through is probably like, we'll find a way, because we always have. I now have a 5-year track record of like biting tooth and nail so that this thing is going to become a thing, right? Like, going gray. I now have a chronic health condition as a result of stress that, like, I'm not the only founder that has one of those, right? And I'm kind of laughing as I say it. When I discovered this, it was obviously like wildly painful to grapple with. It's sort of health issues that ironically impact fertility, actually. So for me, there's sort of this exactly, it's like a universe. It's sort of a enormous fuck you moment. But to be honest, like, I turned it around into like, well, actually, hang on a second. Like, I've given so much up for this. I'm not going to quit now. Like, absolutely not.
Capital efficiency as a competitive advantage. The hardware founders who have stretched the furthest on the least capital do not treat leanness as a constraint. They treat it as a design decision that makes everything sharper.
Look, when you take someone like Tesla, they've built this sort of vertically integrated business, which is certainly a way of doing things and has been proven, of course, for them to now produce large numbers, but hugely capital intensive, and takes a long time also to have a team doing that storming, norming, performing piece. And I think you need that when you're building products like Tesla are. But for us, we're very clear on what the product needs to be. So that is so clearly defined that actually when it comes to, hey, we need some really amazing brakes developed for our car. We want them to be super lightweight. We want them to have these performance characteristics and made in these materials. Rather than building a team that are experts in brakes that we go out, we hire, they sit there for a few months, someone argues with someone else, leaves, and this whole thing takes time to gel together. Instead, we go out to the experts that are already operating in that space and say, hey, this is what we want. Design that for us. And that happens super, super fast. And it also means that we can be clear on the things that we need to design and develop and stay focused on them. So we managed to create from from effectively our drawings from CAD through to putting a fully driving vehicle on the road. We think we've done that faster than anyone else, or certainly no one's come to challenge us on that since. And we did that in 7 months. And that's because rather than having a team of 2,000 or 3,000 engineers sat there all working together on that, we're pulling them together and they're collaborating digitally. So that's a big part of our operating model, is that decentralized piece of talent for us. We move really quickly, and we're going to have to if we want to compete. And speed and agility is one of those things that we have on our side. But with that, of course, comes a lack of consistency, perhaps. And a lot of people hopefully thrive in that sort of startup culture. We will always maintain a scrappy startup way of operating, because having seen 2 examples of very large automotive companies, one had very little money all the way through, and the other had billions of dollars put into it at the very beginning. And the same people working at both of those companies, the way that they operated was so different. One, everyone was creative. They were always thinking around problems, and they came up with solutions that really actually benefited the company and the customer. The other just threw money at the problem, brought in consultants or worked with third parties, and never really got to understand those problems. So we will always operate in the leanest way possible to keep everyone as creative as they can be. So it would never be an easy corporate role at Longbow, that's for sure, intentionally. And I think someone that doesn't just see the role they're given as the boundaries within which they operate. And the only example of that I can give, maybe bringing us full circle to where we started on the call about anecdotes of Elon, is that I maybe stupidly looking back on it now, sat in a car once with him and mentioned, you know what, Elon, here in the UK, people like to hang their suits up in the back seats, because a lot of people travel around, salespeople, they want to hang up a jacket in the back, and there's nowhere to do that. And Elon didn't have that in the car because there's a whole other story about his mum hitting her head on handrails and all sorts. But to cut the story short, he said, okay, design one. And that was it. And then he chased up with me about 3 days later. And bearing in mind, I'm looking after the market and sales and understanding a whole load of other things, not involved in design or engineering at all. But I ran off to a university. I found a great design student that could work with me to CAD things up, another engineer that could do some design for manufacture. And in about 4 days, we had created this hook effectively that go in the back of the car, and then work with Franz von Holzhausen, the lead designer over in California. And that was it. It was then considered for Model X. So that kind of approach of, okay, we've hired you for sales, but if you find a problem, go and solve it, figure it out. That would be the ideal hire for us. You don't even need to have the experience in automotive necessarily, but you need to have that, how do I solve a problem that no one's thought about before attitude. Not asking for much, are we, Chris?
Well, the challenge with the founder, the challenge is that you don't have the budget yet to pay the people to do what you don't know. But the reality of it is you get nowhere if you don't get left in the project, right? You can say, oh, well, I only have this much runway. But if you don't have left, the runway is irrelevant, right? So sometimes you just got to say, I got to pay somebody to do this because it's not going to get done if I stay stubborn and say, well, I don't have the money, but I don't know what I'm doing, right? So those are the hardest decisions. Say, I have to, you have to make a decision on absolute what I have to and what is absolutely going to be critical to the project. So that was those moments where it's like, okay, I can do this, so I'll do most of this stuff myself, but assigning this duty and saying I'm going to have to pay some money, it's just part of it.
The moment it gets real. Every founder in the show has had a moment when external validation changed what was possible, not just financially, in how they saw what they were building.
I thought probably the first big win we had was when we applied and got onto the Bethnal Green Ventures cohort. I think that was, so at the time we weren't even a limited company. We kind of just 2 guys with an idea, and we had already created those smart plugs at the time, and we actually had a few people testing the stuff. But that was really when kind of the external validation that, okay, there's actually something in this, and other people agree, and we think this could be a thing. So that, it gave us a bit of money to start doing a bit more stuff, but also just that the validation and the network that they've subsequently given us, and they're great people. And I think their next cohort is open now for application. So I would always recommend Bethnal Green Ventures to people. They're a great team, back some really interesting companies, and they're it's not just the money or even just there's like a 6-week program. It's the kind of ongoing support and connections, and also just particularly in London in the climate tech scene, they're well known, respected. So when you say they've backed you, people sort of pay attention. So that felt pretty good at the time. And then I guess from a product point of view afterwards, it was developing prototypes. The first time we showed people our kind of latest version of a prototype, we took it to an event, and just seeing people see the product for the first time, especially because it was an event called Solar and Storage in the NEC, and it was a room full of solar panels and kind of big batteries and just, again, stuff completely inappropriate for anyone like me. So people seeing our product immediately, they could see this was a different product, this is something new, and seeing that kind of hitting the mark we got the reaction we wanted, and that was exciting.
It's bootstrapped. We've got some good interest, and we've got I would say probably another couple of weeks worth of back and forth with some different. I would say at this point we're at a angel investor pre-seed because we don't really have any sales yet. We start next week or the week after with actual locks on doors. So we'll see what happens in a couple of weeks. But a lot of these guys are just kind of waiting to say, hey, is it going to work? Is it going to, you're going to be able to get the sync through? So as far as financing, everything so far has been me. We do have a great, I would say, a handful of people that are kind of like, okay, you're onto something. Let me see how much we can come up with. So we have funding in the works. We haven't really raised anything yet, but I would say by June we'll need to be, in that moment, because we're gonna have to manufacture enough to get, the next chapter. So it's all been bootstrapped so far.
Just this year, women's health has been really highlighted as not just an area that we must invest in because we must, and we must do good, but an area where there's an enormous amount of opportunity to make money here. And if you're not invested in women's health, you're going to miss out. And I think there's starting to be institutional recognition of that from a venture and an investment side. And I hope that starts to drive behavior and change in funding for these issues.
9 guests, all of them are building or backing hardware. All of them are linked below. If any of this resonates, the full episodes go much deeper. Thanks for listening to Why Design. If this episode gave you some new ideas, share it with someone in your team who'd find it useful. And follow the show so you don't miss what's next. And if you're building a product team or looking for your next challenge in design or engineering, that's exactly what we do at Kodu. We help companies hire smarter and faster and help great talent find work that actually fits. I'm Chris White. Connect with me on LinkedIn and let's keep raising the bar for design leadership. Until next time, stay curious, stay creative, and keep asking, why design?